But first up here, we got to talk about the market's reaction to that June inflation print coming in softer than expected. Now, futures initially did jump following the data coming out, and since they've seesawed a bit, you're looking at gains across the Dow and the S&P up just 0.1%. The Nasdaq moving just below the flat line there. Now, for all items, we did see inflation decline 0.1% month over month versus 0.1% gain economists were expecting. So joining us now on this, we've got Krishna Memani. He is Lafayette College's CIO. Krishna, thank you so much for being here in studio. We really appreciate it. What does this mean for when the Fed is going to cut is the key question, right?
Yes, definitely. The issue, though, I think what it is implying is September is in the bag. But we have to remember that there's still substantial time between now and September, and lots of reports that can come in that can put a little bit of a damper on things, as we saw in the first quarter of this year. Having said that, I think the trend has been pretty persistent, and the likelihood that they cut in September is quite high. From a market's perspective, though, there are a couple of other issues to be mindful of. One, valuation levels for equities. Yep. And the transition from a soft landing to a recession is not as gradual as people expect it to be. And I think, as you see from the consumer, if you continue to see signs of that, I think people would start questioning the growth trend, specifically the nominal growth trend, and which is probably the most important thing for earnings, which need to be really spectacular to support these valuations.
So then does that tell us that maybe July should be on the table?
I think July should have been on the table based on today's report, but I think the Fed would like to tell you ahead of time what they're going to do. My expectation was that they probably won't tee up September, but I think given today's report, it's quite likely that they tee up September.
When do they do that?
I think after the meeting, they can bring in all sorts of people throughout the next few months to kind of job on the market into that positioning.
Krishna, Chair Powell's comments down in D.C. these past few days have largely been characterized as dovish, and he was talking about some of the weakness that he's been noticing, and many economists, and here on our program, have been talking about some of the weakness that we've been seeing. The numbers clearly put it in the labor market. I'm curious how you're looking at that, and the longer we do see the Fed wait to cut rates, how much higher we could see that unemployment rate go.
Well, so I think the trend in the labor market has been quite consistent. It's been slowing down for a reasonably long period of time. The question really is, would July versus September, would that really make that much of a difference in the state of the economies? And I think in the Fed's judgment would be that it probably doesn't. So I don't think it changes the picture for what they are going to do. And employment is their second mandate, and that's what Powell was talking about. So I think given everything that we see today, September looks a lot more likely than it would have otherwise.
When would it change? If it were to wait to December, would then we see more material weakness within labor market?
Well, so I think the risk is, and the risk that they worry about a great deal is, they basically extract a loss from the jaws of victory. That is, because they waited as long as they did, the economy actually is in a downward trend and accelerates that. I don't think that would be the case. That is certainly not the base case, but I think that's something that is in the back of the Fed's mind, has been in the back of their mind, and that's why they started talking about things in November, because they didn't want to be too late.
This is going to start like a politics question, but I promise it's a Fed question because there's so much political volatility right now, obviously, and uncertainty. Does that spotlight on the Democratic ticket take any of the pressure off of the Fed around looking too political because they don't even know which candidate they're potentially backing?
I think the Fed has been, at least Jay Powell has been very clear about that they don't do politics. And I think we have to take them at face value. If the numbers come out the way they have been coming out, the likelihood that they don't cut in September because they would look political one way or the other, I don't think that's something that we should assign a great probability.
But people might, right?
People might, but I think he will have to kind of defend his position in a meaningful way, and I have no doubt that they will. But I think in scheme of things, they have done things in the past in these types of situations, and I think for us to expect that they would do something else when the economy is slowing down the way they expected it to, and they have kind of laid out the path for us already, I don't think that's very likely.
Krishna, when it comes to some of the trends that we've been seeing within the economy, I guess, are you convinced that this disinflationary story is intact? And it seems like largely consensus right now is yes, obviously on the heels of this print. But I'm curious, in terms of the future prints that you are watching outside of inflation, what do you think is the most important metric to keep an eye on?
Well, I think the inflation part, even if it accelerates for 1 or 2 periods, I don't think that gets the Fed that worried. I think right now the baton, the kind of their thinking baton, has moved to employment report far more than inflation. So if employment kind of reaccelerates for some reason, I think that takes away the incentive to cut, because at the end of the day, what they want to do is make sure that the economy doesn't go into a severe slowdown where they are forced into cutting very aggressively.
All right, Krishna Memani, Lafayette College, Chief Investment Officer. Thanks so much for joining us here on set.
Thank you.